Okay. Good morning, good afternoon, good evening, good day for everyone, wherever he is. If you have not assisted in the first part of the conference, we start now the second part of this conference on financial cycles, risk, and macroeconomic causes and consequences, that is hosted by the Systemic Risk Center at the LSE, which focuses on research on uncertainty, on business cycles, capital flows, and the macroeconomy. I will be leading you through this second part. I just relinquished my duties as executive board member at the European Central Bank. And on financial risk, I think as governor of the Central Bank of Luxembourg about 20 years ago, I was among the first central banks to issue a financial stability report. And at the ECB, I have also been in charge as vice chair of the single supervisory mechanism on the microprudential side. So we try to focus on all three aspects of monetary policy: macroprudential, macroeconomic, and microprudential. We are looking into the interaction of monetary policy with financial stability. Maybe we look for need for changes in central bank strategy and in the instruments that they are using due to the pandemic. But I don't make an introductory statement. We have a distinguished panel composed of academics and practitioners, of policymakers and researchers. And I am very pleased and honored to present to you the different speakers who will be in the order. First, Isabel Schnabel, who is a colleague, a former colleague of mine at the ECB, in charge of markets. But she has also a long career as professor for financial economy at the Bonn University and other German universities. We also have then Alex Brazier, who is the executive director of the Bank of England for financial stability strategy and risk, and he's a member of the FPC. He has been a principal private secretary to former governors. We have as a third panelist, Pat Parkinson, who is a senior fellow at the Bank Policy Institute. And at a long career at the Fed, he has been deputy director for research and statistics, and he has also been the director for banking supervision and regulation. And finally, we also have Joan Danielson, who is a reader in finance at the LSE, but also a director of the Systemic Risk Center, the organizer of the conference. Let me recall also that this conference is being recorded and live streamed on YouTube. And the intention is also to make it a subject of a podcast if there are no technical difficulties. At least I am not aware of any. Let me, for housekeeping, also remind you that the speaker's introductory statements will be no more than 7 minutes long. And then we will have each speaker reacting to the other ones before I will open the audience for the questions that will come from them. So without further ado, let me turn to the first speaker. Isabel, would you start with your introduction?
Thank you very much, Yves. It's a pleasure to be on this panel, and of course, particularly to see my dear former colleague, Yves, here on this panel. So let me try to share my screen. Oh, well, can you see it? Can you see my screen?
Perfect.
Okay.
It's very kind.
Excellent.
Please.
So let me tell you that what I'm telling you today is a shortened version of a longer speech that, of course, you will find on the ECB's website together with the slides. So I'm going to talk about what is called the sovereign bank corporate nexus. So in the current pandemic, there have been forceful responses of fiscal, monetary, and prudential authorities, which help to significantly reduce the economic and the social cost of the crisis. In particular, the governments have stabilized aggregate demand and incomes by absorbing economic and financial risks of the private sector, in particular by issuing generous guarantee schemes, which secured a continuous flow of credit to firms, of course, supported by ample liquidity provided by monetary policy. And as a consequence, the interdependencies between sovereigns, banks, and firms have intensified, creating a sovereign bank corporate nexus. So now I cannot move the slides. Well, what do I have to do? Oh, it works. Thanks. So at the onset of the pandemic, the strict lockdown measures hit large parts of the corporate sector very hard. And this raised their vulnerability to levels that we had last seen during the global financial crisis, as you can see on the left-hand side. Many firms, in fact, saw their revenues collapse and they were facing acute liquidity shortages. And in response, and this is shown on the right-hand side, governments swiftly launched broad-based support measures, including job retention schemes, direct transfers, tax cuts, deferrals, and loan guarantees. The ECB supported bank lending to firms by providing ample liquidity at favorable conditions, while the prudential authorities took comprehensive supervisory relief measures. And together, these measures helped prevent an abrupt contraction of credit to firms and a wave of corporate defaults, and thereby protected banks' profitability and balance sheets. So thereby they created a virtuous circle between sovereigns, banks, and corporates. But of course, this also implied that the interlinkages between sovereigns, banks, and firms have grown. So on the one hand, the sensitivity of public finances to future corporate and financial sector developments has increased. And on the other hand, banks and corporates have become more dependent on government support. But the nature of these interdependencies differs fundamentally from previous crises. Most notably, the crisis did not originate in the financial sector, as in the global financial crisis, but in the real economy, and public support was granted to firms, not banks. And moreover, the pandemic has not raised concerns of moral hazard. Government support during the pandemic has protected the economy in the face of an exogenous shock that was not caused by excessive risk-taking. At the same time, with the banking union still incomplete, the pandemic has exposed old vulnerabilities. For example, banks have increased their sovereign exposures. And in fact, bank and sovereign credit ratings remain highly correlated in the euro area. So what would happen if government support was withdrawn abruptly? This could then lead to cliff effects, giving rise to financial instabilities. It could trigger corporate defaults, a rise in non-performing loans, and of course, tighter financing conditions. This could cause problems in the banking sector, it could deepen the recession, and ultimately, it could also put pressure on the sovereigns. In other words, the interlinkages between sovereigns, banks, and corporates, which were crucial for stabilizing the economic and financial situation during the pandemic, could turn into a vicious cycle. Whether this could happen depends on two conditions. First, on the effectiveness of the policy support. The responsible and timely use of funds provided under Next Generation EU can reinforce the cyclical recovery and bring the economy back to a higher growth path. Higher and more sustainable economic growth will be the most important protection against vulnerabilities in the future. Second, it will depend on the degree of divergence among euro area countries. Banks in more highly indebted countries also tend to exhibit higher domestic sovereign exposures and higher corporate NPL ratios. To a large extent, this reflects unresolved legacy issues. And countries with high sovereign debt levels are also those that are more dependent on industries hardest hit by the pandemic, such as tourism, resulting in a larger drop in corporate profits. This underlines the importance of support at the European level. The Next Generation EU instrument helps alleviate potential strains on national fiscal space and thereby attenuates the sovereign bank corporate nexus. At the same time, this is a reminder of the urgent need to make further progress on reforming the euro area's institutional architecture by completing the banking union, by advancing the capital markets union, and by reviewing the European fiscal framework. From the viewpoint of monetary policy, the potential emergence of an adverse macro-financial feedback loop would matter for at least two reasons. First, it could slow down the return of inflation to our medium-term inflation aim. Second, it could impair the smooth transmission of monetary policy through financial instabilities. The risk of a premature phasing out of fiscal support is outside the ECB's control. But we continue to call on governments to extend targeted government support for as long as needed and to use public funds with a clear focus on raising productivity and long-term growth potential. At the same time, the ECB reaffirmed last week that we will preserve favorable financing conditions for as long as necessary. On the one hand, this means insulating the bank lending channel from adverse developments to the extent possible. We therefore further recalibrated our targeted longer-term refinancing operations. It also means protecting relevant borrowing rates in financial markets from a tightening that would be inconsistent with countering the downward impact of the pandemic on the projected path of inflation. We therefore decided to extend and expand our Pandemic Emergency Purchase Program, PEP. Our focus on duration and preservation combines two benefits. First, the longer duration of the PEP has a stabilizing impact on financial markets. It significantly mitigates the risks of a sudden repricing and of self-fulfilling price spirals. Second, this calming effect has the potential to increase the efficiency of our purchases. It allows us to calibrate our purchases flexibly according to market conditions, consistent with our commitment to preserve favorable financing conditions. As President Lagarde highlighted last week, this requires the Eurosystem to maintain a strong presence in euro area bond markets. In summary, we are sending a clear signal to markets that we will continue to provide the necessary support to bridge the time until the pandemic is over. Let me conclude. The decisive policy response to the COVID-19 pandemic has successfully prevented a much deeper economic contraction and averted threats to financial stability. Now, governments must ensure that the current virtuous sovereign bank corporate nexus does not turn into a vicious circle by minimizing the risk of cliff effects and by using funds responsibly. The ECB will support this by preserving favorable financing conditions for as long as necessary. Thank you very much for your attention.
Thank you very much, Isabel, for being so clear on the position of the European Central Bank. I will turn now to Alex, who will present his view of the situation. Alex, please.
Yves, thanks very much. And Isabel, that was very interesting. I'll try and build on some of that in my remarks as well. I want to talk about, as the title says, the interactions between the financial risks and the macroeconomic outcomes we've seen, and hence central bank policy. And I think they fall into three categories. You might call them the good, the less good, and the downright ugly. And so let's start with the good. As Isabel mentioned, the banking system has actually been a source of strength for the economy in this crisis, contrast to the financial crisis when it was the exact opposite. The scale of the economic shock we've seen, is such that it's going to generate losses for banks, or could have generated losses for banks, and at least uncertainty about losses for banks, on a scale that, had we had the banking system of 2008 today, with all its short-term funding and leverage, we wouldn't just have a public health crisis and an economic crisis, we'd have a banking crisis as well. That we are a million miles away from that, I think, is testament to all the reforms over the past 10, 15 years since the financial crisis to build more resilient banks. And actually, that's meant we've been in a much better position to avoid a sudden tightening of credit conditions during this episode. Banks have been able to, first of all, maintain lending, and then, as Isabel said, with the support of government guarantee schemes, to expand lending, which has been absolutely essential to meet the liquidity needs of corporates. I mean, we looked in the UK at those liquidity needs, and companies in the UK have probably, even after the very powerful job furlough schemes and other government grants, had a cash flow deficit of around £200 billion this year. With only cash on hand of 100 billion, that's required a big surge in financing, and the banking system, supported by government schemes, has been able to do that. So it's really been essential to helping companies weather the economic disruption, in the process to minimize the degree of economic scarring from that disruption. And as a result, avoided monetary policy, which is close to its effective lower bound, from having to do even more than it has already had to do. And I think the big lesson from this is that when you're close to the lower bound for monetary policy, financial stability is even more important than it is at any other time, because you don't want to use up valuable monetary policy space dealing with financial shocks when you've got economic shocks you need to deal with. So that's the good. The less good, I think, and this goes a bit to Isabel's comments on the corporate sector, the less good is the position we went into this crisis in terms of corporate debt. We had, at least in the UK and certainly in the US, had a period of growth of corporate leverage, and it wasn't really an aggregate problem, but a pocket of highly indebted corporates that emerged. The distribution of corporate debt had become quite skewed. And that risked, I think, a bad interaction between financial risk and macroeconomic outcomes. And that's for two reasons. The first is that some companies have found it more difficult to raise finance because of their starting leverage position. And that's risk, therefore, more scarring as a result of the economic disruption. But the second is the level of debt we will end up with in the corporate sector, as companies, with some of which had already had high debt, tried to bridge through this with more debt. means that a number of companies may, after this crisis, want to repair their balance sheets. And that, unless they have access to equity finance to if you like, deleverage their balance sheet, they will be tempted to hold back on hiring, hold back on investment, to sort of organically repair their balance sheets over time. And that will act as something of a dragging anchor on the recovery. As Isabel said, it may make it more difficult or slow the return of inflation to target, or in other words, it may keep the neutral interest rate lower than it would otherwise have been for some time to come. So I think we believe it's essential, therefore, to try and get companies with as much access to equity as they need in the recovery phase, which is why we're thinking about policies to encourage the supply of what we call productive finance, so longer term equity-like investments, so that companies who feel they want to adjust their balance sheets can do so financially rather than by holding back on economic activity over a potentially long period. So that brings me to the ugly, which is where I want to dwell for a bit, because what happened last March in many ways was very ugly, but it was particularly ugly in financial markets. Now, we would have expected some adjustment, some sharp adjustment in response to the economic news and the news about the path of the virus, but it morphed very quickly into what we now call a dash for cash, or a scramble for liquidity amongst various non-bank financial intermediaries, funds of various sorts. And that resulted in massive selling pressure in a number of very core important markets, the corporate bond market, sovereign bond markets in the UK and the United States, for example, and the euro area. That threatened very serious tightening of financial conditions. Now, it didn't ultimately have that effect because monetary policy stepped in with huge asset purchases. So it solved the problem. And I think this is part of the danger that people now forget about it, but I don't think we should, because those policy actions had three, if you like, side effects. The first is that we won't always be able to rely on the coincidence that monetary stimulus is needed at the time these problems occur. This time it was lucky, but it won't always be that case. So it's not sensible to rely on monetary policy to deal with these problems. The second is that asset purchases take risk onto the central bank and hence the public sector balance sheet for a long period to deal with what should be a short-term problem. It's not necessarily the most efficient way, even if it's a very effective way of dealing with it. And thirdly, asset purchases in the open market at prevailing prices do little to create the right incentives for non-banks ultimately to manage their liquidity prudently. There was no penalty or insurance premium for scrambling for cash in that episode last March. These are all reasons, by the way, why we don't provide liquidity support to banks through monetary policy operations. We have separate liquidity facilities for banks with penalty rates and such like. So we think now we need to examine, or central banks should examine, whether they need facilities to lend to a broader range of counterparties with the aim of supporting the functioning of core markets, but in a way that isn't just effective, like the actions we took last March, but that also creates the right incentives and does it as efficiently as possible. And of course, if you're thinking about widening access to central bank facilities, then actually you need to think, as for many years we've done with banks, well, what's the regulatory quid pro quo for that access? And many of this scramble for cash back in March actually was the result of structural fault lines in many of these non-bank intermediaries, whether that was the redemption offering of funds, open-ended funds and money market funds, whether it was the fact that various players hadn't prepared for margin calls on their derivative positions, or whether it was over-leveraged investors like hedge funds in some markets. That's why this is a big post-crisis reform agenda in the G20 Financial Stability Board. And for me, it's the big lesson of this crisis in the part of the financial system that didn't work as well as it should have done. The problem was dealt with, but that solution, monetary policy, isn't one we should rely on for all future crises. Thanks.
Thank you, Alex, for reminding us also the limits of monetary policy, that according to British literature, it cannot be a small god for everyone and everything. I turn now to the third speaker with extensive central bank experience, that is Pat Parkinson. Even now he is in the Banking Policy Institute. Pat, what is your side view? Please unmute yourself, Pat.
I wish I had a dime for every time I've done that. I was saying, I think what I'll be saying will very nicely complement what Alex just said. I'll be focusing on the ugly, but perhaps other dimensions of why it was so ugly. So thanks for the opportunity to participate. What I'm going to do is focus my remarks on a paper titled Enhancing Liquidity of the Treasury Market Under Stress that I co-authored with Nellie Lang and which was published in December by the Brookings Institution. I should emphasize, this is something I got used to as a central banker, however, that the views I will be expressing are my own and do not represent positions of the Bank Policy Institute or the Brookings Institution. So as we all know, and as Alex just mentioned, liquidity in bond markets in the United States and elsewhere evaporated in March 2020 as the economic and financial implications of COVID-19 became apparent. Large and widespread selling of bonds by non-bank financial institutions, but also by foreign central banks and many others, simply overwhelmed the supply of liquidity by the securities dealers that act as intermediaries in the bond markets. The Federal Reserve took massive, unprecedented interventions to restore market liquidity. Although the evaporation of liquidity, especially in the US Treasury markets, came as a shock to both market participants and policymakers, in retrospect, it perhaps should have been unsurprising. There has been extraordinary growth in the Treasury markets and other US bond markets. Alex mentioned the corporate bond markets. In recent years, there's been increased holdings of Treasury securities by investors that may need to rapidly sell them in periods of stress, like leveraged investors, and a substantial reduction, and this will be what I'll mainly discuss, in the capacity or willingness of securities dealers to meet demands for liquidity in US and I suspect in other bond markets. In our paper, Nellie and I focused on potential measures for increasing supply of market liquidity under stress, not because we believed that measures to limit demands under stress were unimportant, but because we were confident that others, including the FSB, were giving those measures considerable attention, as I think Alex has confirmed. First, in terms of what we're talking about, first, we proposed certain targeted changes to banking regulations that we believe would encourage bank-affiliated dealers to allocate more balance sheet capacity to bond market intermediation, and importantly, without reducing overall bank resiliency. The most important change would be a permanent exclusion of reserves at the central bank from the denominator of the Basel III leverage ratio, a measure that the Bank of England wisely adopted well before the COVID crisis made clear that the inclusion of reserves can be highly procyclical. Other changes, including replacing the existing US leverage buffer with a countercyclical buffer and changes to the G-SIB surcharge methodology, are discussed in my paper with Nellie. But these bank regulatory changes alone are unlikely to be sufficient, even setting aside the need for the measures on the demand side, and importantly, might have the perverse effect of further concentrating market intermediation in the small number of G-SIBs that already dominate bond market intermediation. To avoid this outcome and to support overall financial stability, we proposed additional measures, including creation of a new Federal Reserve standing repo facility and serious consideration of a mandate for wider central clearing of US Treasuries. With the credit needs of the US economy met more through bond issuance in markets than through bank loans, the Federal Reserve's discount window, which access is limited largely to commercial banks, may no longer effectively support the credit needs of the US economy in stress situations. A standing repo facility would provide backstop secured financing of Treasury securities to both bank affiliate and independent broker dealers at prudent haircuts and at an interest rate modestly above the current market, so as to ensure that the facility would be used only in abnormal market conditions without stigmatizing use of the facility, because we've had lots of problems in the US with stigmatization of the existing discount window. Now, Alex mentioned concerns about moral hazard, and those are very important. And as he suggested, you need a quid pro quo. And in this case, we proposed addressing the moral hazard by conditioning access to the standing facility on meeting prudential requirements established by the Federal Reserve. those prudential requirements would be tailored to the size and complexity of the dealers, because I think you're mainly trying to get smaller dealers to step up, which would allow smaller dealers to compete more effectively with the G-SIBs that currently dominate market intermediation. With respect to central clearing, although a CCP for U.S. Treasury securities has been in operation since 1989, a small and declining share of trades in U.S. Treasury securities are actually cleared through that CCP. Dealer to client trades, which are about half of all trades in U.S. Treasuries, have never been cleared. And the share of what are called inter-dealer trades that are cleared has declined as a growing share of such trades, in fact, are not between dealers, but are trades with so-called principal trading firms and other counterparties like hedge funds that do not participate directly or indirectly in that CCP. Wider CCP clearing would increase the balance sheet capacity of dealers, especially bank dealers, because accounting and capital rules recognize the risk-reducing effects of the multilateral netting of trades that a CCP achieves. Wider CCP netting could also enhance the ability of smaller dealers to compete with the dominant firms, especially if wider use of a CCP results in wider use of all-to-all trading platforms, rather than the existing dominance of over-the-counter trades, and particularly in the dealer-to-customer space. But for that to occur, the rules of CCPs and trading platforms need to provide fair and open access to large and small dealers and other active market participants. It may also require a mandate to use all-to-all platforms for execution of some trades. In one respect, what we're calling for here is what was done post the last financial crisis in terms of OTC derivatives, clearing mandates, and at least in the US, a mandate for execution through regulated platforms. And last but not least, intelligent reform of the US Treasury and the all-important repo markets requires greater transparency regarding the terms of trades and the types of scale of activity of market participants. In recent years, regulators have collected additional information on trading, but those efforts have been incomplete, particularly with respect to repos, I think. Furthermore, most US regulators have demonstrated no appreciation of the need for public transparency. I actually think the SEC is the exception here. Public transparency is necessary, I believe, both to inform policy debates and to hold the regulators accountable. While this presentation has been very US-centric, I hope and believe many of the issues I have touched on are relevant to bond markets around the globe, which also have been growing rapidly in recent years. Thank you.
Thank you so much, Pat. This is yet again broadening our views on the possible responses to the crisis. And I think this would be worth discussing during the coming minutes. I will, however, before doing that, turn to Jon and ask him from the lecturer's point of view how he would make some suggestions. Jon.
COVID-19 did not cause a financial crisis. And of course, the reason is it's a demand crisis that hits a relatively resilient financial system made resilient by the responses or changes to the system following the crisis in 2008. The central bank certainly responded forcefully, however. We have a variety of liquidity programs, macroprudential relaxations, and most importantly to my story, the Federal Reserve's US dollar swaps. Now, a common narrative maintains that these central bank programs are the reason why 2020 did not become a global crisis like 2008. It is, of course, hard to prove a negative, and the jury is still out, and I suspect that debate will occupy researchers for years and decades to come. But we do now have some ways to assess the effectiveness of how the central banks respond, and that's exactly what we at the Systemic Risk Center have done. In doing so, we are helped greatly by a unique and rather fantastic data set provided by our data partner IHS Markit. And this data allows us to shed light on how the central bank's interventions affected financial markets across maturities and assets. If you're interested in the details, we did have a Vox EU opinion piece today on the topic, and that is accompanied by a proper academic research paper. But at the heart of this is option prices covering 250 market indices and 3,000 stocks in all key financial centers in the world. And was especially to me fantastic in the data covers maturities anywhere from 1 week to 30 years. So we can see how the markets see 30-year risk responding to a central bank intervention in March 2020. Our variable of interest is fear, the market fear of large losses. And the first conclusion is that the 2008 and the 2020 crisis are remarkably different. Fear increased in both crises, but the increase in fear was much more fleeting in 2020 and then almost exclusively confined to the short term. The financial markets never perceived the COVID crisis to be very serious or threatening to the long run, neither before, during, or after the central bank interventions. So maybe there was no reason for the central banks to respond at all. And now I find something interesting, because when we look at policies aimed at the wider economy support, like credit to households and businesses, they had no impact on market fear in the United States. So Isabel is discussing exactly how powerful this was in the Eurozone. Alex, this is the same for Britain. We do have the data for the ECB and we do have the data for Britain. I'm very much looking forward to see how the DAX and the FTSE responded to both the Bank of England and the ECB. And I think we'll do so promptly. But in the United States, there was a zero response by the stock market to any policies directed at households or businesses. Possibly quite different in Eurozone, of course. Now, we do suppose the Fed's primary objective was to alleviate immediate market fear, pour oil on troubled water, if you will, targeting the short term, but not the long run. But however, what we find is that some of the strongest impact of the Fed interventions were a reduction in long-term risk, years and decades into the future. And the most powerful intervention by some margin was the US dollar swaps. They reduced market fear across all horizons. And interestingly, a policy ostensibly targeted at foreign borrowers significantly reduced the risk in US markets. And we can provide more color on this by looking at individual stocks. And I guess can do no better than looking at the largest bank, JP Morgan, and the largest retailer, Amazon. No surprise that the Fed interventions had a much bigger impact on JP Morgan than Amazon. After all, we would expect the immediate benefit of the Fed interventions to accrue to the financial markets and its institutions rather to its retailers. The macro pru relaxations are particularly interesting because they significantly reduced both short and long-term market fear. No surprise for Amazon, because this might lead to, say, less troublesome bank financing. But for JP Morgan is less obvious. The macro pru relaxations are explicitly designed to relax risk constraints on regulated banks, thereby increasing the riskiness. One might have seen the market perceive this as increasing the tail risk, especially in the long run. That is, the market should have responded by saying banks are more risky, not risky. That's exactly the opposite of what happened. And perhaps the banks perceived the Fed interventions as signaling its willingness to intervene in the future and therefore make the industry less willing to pay for disaster insurance, because now the Fed has become that insurer. In turn, that may be highly suggestive of moral hazard. If the market sees the central bank as willing and able to calm short-term fear in March 2020, it will also expect the same in the future, which then may lead to less vigilance and more buildup of risky positions. And now you can see the ratcheting that this might lead to. And if you read some recent documents, then you see exactly how this is happening. The Fed may not have wanted to increase moral hazard, but it certainly appears the market perceived it as increasing moral hazard. And finally, we can look at the global markets and how they were affected by the FX swaps. we have three categories of countries. We have Britain and Germany, who always had access to the FX swaps, those who never got access, and finally the likes of Korea, who got access midway through. What we find is that there is almost no impact of the FX swaps on countries who never had it. The impact is only realized after Korea got it, but there's a strong and significant reduction in both the FTSE and the DAX index as a response to the US swap lines. Now, of course, this is effective because they reassure US dollar borrowers that they will not be starved of the dollars they need to fulfill their obligations. But there's a secondary, more important conclusion. It reaffirms the US's commitment to the global financial community, even when such commitments have come under increasing strain elsewhere in US policymaking at the time. Which takes me to a curious point. There's a long literature out there on the power of the Federal Reserve and how the US dollar is a global fear factor and how US monetary policy decisions affect the rest of the world. Our results strongly support that view, and they confirm that if anything, the global power of the Fed has increased considerably. And particularly curious is that Fed swap lines that are implemented by domestic central banks, like the Bank of England and the European Central Bank, who end up acting as a conduits of liquidity from the United States to their own markets. To be slightly glib, it's almost like they were acting as the 13th Federal Reserve Bank. The swap lines and the willingness of domestic central banks to intermediate them further incentivizes the rest of the world to continue relying on a funding structure the local central bank does not control. And the end result may well be further moral hazard and the cementing of the pivotal role of the US central bank in the world. But the markets were certainly calmed. But maybe that success came at a cost. Our overwhelming empirical evidence is that the policy interventions, they were perceived by the global markets as providing two signals. First, the central bank's commitment to bail them out in the years and decades to come. And secondly, for the rest of the world to continue to borrow in US dollars. You may recall Hyman Minsky's words some decades ago, stability is destabilizing. And that is a tricky trade-off in all crisis responses. By calming the markets now, the markets may come to expect the same to happen in the future and be incentivized to take on more risk than they otherwise would do. And therefore, the cost to the calming may end up being more financial instability and higher future systemic risk. And that's it.
Okay, thank you. I've already had a short look at the chat box in order to identify the questions which have popped up in the meantime for each intervention that we have heard. But before we turn to the audience, maybe I would like each of the panelists to add a few succinct remarks, if you would like to have some, on the suggestions that were brought further by his fellow panelists. So I will start again with Isabel, if you would like to react already at this stage to some of the proposals.
Yes, thank you very much. So these were very interesting presentations. I mean, I would like to respond to everything, but I will limit myself to the most important things. So I think it's interesting to see that basically everybody agrees that one of the reasons why we haven't had a severe financial crisis is that we had done all this regulation after the big financial crisis 10 years ago. So of course, after this pandemic, even if, as we all hope, there will not be another banking crisis, we will have a banking sector that is much worse capitalized. And we have to ask ourselves, how are we going to get back to a situation as the one we had before this pandemic? And I think this is really, I think this is one of the key questions. For the euro area, this is tricky because banks are so unprofitable. And so it's in fact, it's not just a matter of regulation, it's a matter of structural reforms in the banking sector. And so I think that is very important. In principle, I mean, Pat's proposals, which of course he made with respect to the US, in the end, they amount to reducing capital, if I understood it correctly, unless you design it in a different way. And I think this is certainly not the way we should go. So the question is, how do we get higher capital in the banking sector? The corporate sector was mentioned by Alex, of course, is another a crucial issue. I very much agree that the debt overhang is a problem and that equity should play a much larger role, and that we, I mean, should have thought in this direction already much more immediately as a reaction to the pandemic. So I think this is certainly important. On Jan, very quickly, of course, swaps played a very important role. I mean, I would be interested to see how you exactly identify the different the effects of the different policies, because of course everything was happening more or less at the same time. So I would be interested to see how clear the identification can actually be. But I have no doubts that swaps were very relevant. By the way, even euro swaps were gained importance quite a bit over the pandemic. I thought that was also interesting. On your point on the macroprudential, I'm not sure whether I agree with your doubts that you raised. I mean, of course, I would think that the release of macroprudential buffers in the middle of a crisis, that this would be stabilizing, I don't find surprising. This is exactly what we would expect. The question, of course, is whether this will ever go up again. I mean, later, that's the big thing. So let me stop here. Thank you very much.
Thank you, Isabel. I turn to Alex.
Thanks. So just very briefly, I guess my main reflection is that there's a sense amongst all of us that there was a big increase in the demand for money and the demand for liquidity amongst particularly non-banks in March. And that demand was met by central banks. And because it wasn't just domestic kind of money demand, it was dollar demand as well, for all the reasons John outlines. The swap lines had a big effect as well, although I do share Isabel's question about, can you really identify the specifics? But I don't find it too surprising that actions that meet a sudden surge in the demand for liquidity reduce systemic risk in the short term. I think the issue, though, as John was saying, is how we sort of succeeded in meeting that demand, but did we meet it in the most efficient way for the future? And I'm pretty clear that lots of Pat's ideas and other ideas need to be explored, because I'm pretty clear that we didn't meet it we met it in a very effective way, but we didn't necessarily meet it in a very efficient way if you're thinking about the trade-off between short-term and long-term. We did very well in the short term, but may have stored up issues for the long term. And that's why it's really imperative that we have to address them and come up with better ways for next time. I do share some skepticism, like Isabel, of measures that may reduce the resilience of dealers and banks in the hope that they will provide more liquidity in stress. The worst thing you can do for the provision of liquidity in stress is have a dealer fall over. We didn't have that. But I do think it's worth exploring many of the ideas that Pat outlines and others, and central bank facilities as well, so that we can meet the demand for money in a way that's much more sort of careful of the long-term consequences if this happens again. Thanks.
Thank you, Alex. It's of course not only a question whether we need more or more fine-tuned instruments. The question has also been raised whether we would not need an adjustment of our mandate, and that is our strategies. And that is also a question that Pat to some extent raised, because if central banks would go deeper and deeper into different mandates within the financial system, the interaction with other policymakers like macroprudential authorities in countries where they are separate from the central bank, and with microprudential authorities which would be separate, is also on the table. Pat, would you like to react?
Yeah, a few things. I think maybe start with responding to the concerns that the changes in banking regulation would weaken the banking system. I think we were pretty clear that what we're talking about were things that, using actually some words that Alex just used, we don't want to make banking regulation less effective. It's critical that it be effective, and it has been effective. The question is, can we make it more efficient? And the view is that currently, certain regulations, notably the leverage ratios. And of course, in the US, we have an abundance of these, more than in certain other jurisdictions, as we have gold-plated things. They discourage low-risk activities like intermediating in the treasury markets or in the treasury repo markets, and perversely, at least by themselves, would encourage banks to shift into higher risk activities. So, for example, I think what the Bank of England did in terms of excluding reserves from the denominator of the leverage ratio was they did that, and then they recalibrated the minimum requirements so that on net, there was no reduction in the amount of capital that is called for by virtue of that regulation. One could extend that further if you think that, as I think most regulators have said, and the Basel Committee has said, that the leverage ratio should be a backstop. Well, in 2020, they weren't a backstop. They would become, at least for some large institutions, the binding constraint. And the question is, should you make an adjustment to the whole complex of requirements so that the risk-based ratios are binding under all conditions, in particular are binding, and the leverage ratios are not binding under consistent stress. So, and there are other examples of that. I think every time we discussed a regulatory change, we adopted sort of this PAYGO principle. I mean, the Fed has said they think capital requirements are about right overall. So anytime I know, being at the Bank Policy Institute, if we're going to propose changes that would reduce the level of capital in the banking system, if we want to get anywhere, we ought to be thinking about offsetting changes that would undo that damage.
Thank you, Pat. Of course, some of the regulation has not yet been implemented in some jurisdictions, and that also led to some more difficult reactions, whether we would now leave regulation again to become purely national, or whether we would try to maintain the international level of coordination that we have achieved, and which in itself has also been a contributing factor for stability. But therefore, some of the measures to make the whole system more effective are probably more difficult to reach further consensus down the road, and I think we should nevertheless continue to do it. So, Jon, I would turn to you. I see the clock is turning.
So both Alex and Isabel, they raise, of course, the correct point about identification, and we certainly did do that quite carefully. To respond really briefly, you look at how the main index responds in the immediate window around the announcement time, and that gives you a weight for whether the market took it seriously or not. So this is a standard identification technique in the literature, and that's what we did. And that, by the way, is the reason why it's easy to do it for the US and Europe, because we have better data in the US. However, I find the macro pro comments quite interesting, because you both said you would expect risk to go down, long-term risk to go down, but if you read the Basel Accords, the purpose of a capital buffer is to reduce risk. So therefore, because the macro relaxations, they are the relaxations of the capital buffers by definition. So it sounds like you're trying to have your cake and eat it too, to quote our prime minister. That is because on one hand, the regulation designed to lower risk, but then it's lowered and then it's supposed to increase risk. And I find that quite curious, but I have a question for Isabel and maybe Alex, but more for Isabel. I'm thinking about this nexus, and I'm wondering how the ECB sees the longer term. Do you see this as a longer term arrangement? And if not, how will you unwind it? Of course, the dependence on the nexus and the government funding and the government control steadily increases, and the temptation to take advantage of that becomes increasingly tempting within the EU. So how do you go about turning the clock back, or is it a permanent setup?
Thank you, Jon. I think this is the issue that all policymakers are faced with. They have to react short term, but they also are aware that there might be long-term consequences which might not be all seen at the moment, or they are sometimes seen when they are taken. However, from the macroprudential point of view, the problem was that in many countries, no buffers have been set up. So the release of the buffer in many countries were quite minimal and did not was not able to contribute as it was supposed to be contribute, because in many countries they have not even been initiated or activated. But the issue is also with the capital that we are being asking from the banks. This has not yet been fully implemented in many jurisdictions. The full capital requests are still going on, and they have been suspended during the pandemic. So if we are now resuming the request for paying up the full amount of capital that we required from the banks in the Basel Agreement, but which has not yet been fully implemented, then the question is, for what purposes? And I see already proposals where the macroprudential policymakers say it should, part of the capital requirements should be used for macroprudential requirements which are much higher than the microprudential. And the microprudential people, they are very unhappy that the macro people would like to take their instruments for their other purposes. So inevitably, we are running into difficulties of objectives. And I think that is true. In the long term, the objectives might be different between micro and macro, and also monetary policy. So since we only have a couple of minutes left, maybe you have been able to see the questions in the chat box. So if any of you would like to respond to a particular question, I will have a last round, because I think we only have a few minutes left. So please be short in order to respect the time allocated to us. And I will this time start maybe with John the other way around. John, would you like to go back to one of the questions, or ask yourself the questions whether another question obviously is whether the amount of collateral is broad enough. We have Pat is only talking about liquidity being allocated through treasuries, but in the European side, the allocation of liquidity has been much more broadly based. So is that not also a question to be asked? Okay, John, I give it back to you.
No, so I'm just responding to actually, Eve, your words, in that the JP Morgan was subjected to these capital constraints, and we are looking at JP Morgan as a specific bank. So it's not the case of them not being implemented on location. And like I say, I find this absolutely quite remarkable how this all turns out. But of course, you raise exactly the important point. We have to respond to a crisis in real time, and will that have a long-term impact? And what I fear is that we are sort of in a ratcheting mode, where we are increasing the influence of the financial authorities over the economy. If you read the recent holistic report from the FSB on what they propose, they are proposing to expand the Basel framework to all of the non-bank sector, essentially regulate more. And then are we ratcheting between more regulation, more control, more crisis in obscure parts? And what is the asymptotic end to that? So I'm sort of slightly concerned about the whole philosophical direction of where we have been going since 2008. And while 2008 was, we had no choice, we had a choice in 2020. And also a deliberate decision being made to calm the markets when it might not have been necessary. And all the side consequences were quite well understood, because we studied 2008 absolutely to the death. So however, these questions will occupy all of us for the years and decades to come. So I'm not going to finish now.
Thank you, Jon. Pat, would you like to answer some of the questions?
Sure. The only one I actually see is about whether I'm happy with the existing management of risk, recovery, and resolution within CCPs. And I'd have to say, I think that remains a work in progress. It's kind of interesting that authorities around the world, I think I was part of developing that consensus at the time, concluded that at least for OTC derivatives, CCPs were an important part of the way forward. But I think actually that conclusion, when we made that conclusion, I'm not saying it was the wrong conclusion. I don't think the difficulty of the issues around recovery and resolution, and perhaps even of resilience, were as well understood as they should have been. So now CPMI, IOSCO is sort of backfilling and trying to figure out what are the appropriate standards in those areas, and they're tricky questions. I think particularly, again, I think much of the thinking about CCP has been driven by OTC derivatives, but I was talking about treasury markets, and of course in the U.S. We have a CCP for the equity markets, a CCP for the options markets. And in fact, those markets can't exist without those CCPs, because all the trading is in all trading systems, where the only way that works is if you have a central counterparty. So when you talk about resolution, you're certainly not talking about failures. We're talking about, in the case of banks, you're talking about some way of making sure that there's continuity of services while not incenting poor behavior by these systemically important CCPs. So I think there are a host of issues there that I didn't get into, and I don't think we have time to get into today.
Certainly, but you know that the discussion on CCPs is ongoing at the international level. And for me, the most important would certainly be that we maintain an international coordinated effort rather than moving back to national solutions, which would inevitably lead to beggar thy neighbor policies. I turn now to Alex to ask whether he would like to add another question.
Yeah, thanks, Ethan. Thanks, everyone. I just replied to a few things. The first is, I think the big agenda post this I think was the first question from Krishna, is the need to reform the fault lines that were exposed in the non-bank financial system. By the way, I completely disagree with John's characterization of extending the Basel framework to non-banks. It's absolutely not the intention at all. These things need bespoke things to address the fault lines that were exposed, that basically led to the demand for the dash for cash, the massive surge in demand for liquidity. Alongside that, as I said, we need review of whether central banks have the necessary facilities. On the corporate sector, there will be winners and losers from this. The COVID disruption has accelerated a degree of structural change that the economy was already seeing. I don't think it's for the state to pick winners and losers, but it does, I think, emphasize the need for equity so that companies who do have a long-term future actually don't fail because for want of finance. And likewise, companies that want to grow to take advantage of new opportunities as a result of the structural change also have the ability to access growth finance. And finally, if I may, just on the John's puzzle about why relaxation of capital requirements reduces systemic risk and cake and eating it. John, I think you may have completely misunderstood the purpose of capital buffers, which is not to be put away in a locked box, but actually to be drawn on in a stress. If you just lock them away and never let them be used, there's no point having it in the first place, and it actually then is a contributor to systemic risk. So I think the release of the buffer, it relies, of course, on having built the buffers up to start with. That's the key thing. But having done so, it's really important that they're released in a stress so that they can act counter-cyclically.
Thank you, Alex. And finally, Isabel, there are specific questions addressed for the ECB. And there is always the question whether we need more instruments and we need more actors having direct access in the future to central bank liquidity directly without passing by the banks. That is a permanent discussion. Isabel, would you like to answer this?
Yes. So first, I would like to say that I fully subscribe to two things that Alex said. So first, on the macroprudential buffer, that was exactly what I also wanted to say, and also on the non-banks, on Krishna's question. That is that I perfectly subscribe to that. On the regulation again, I mean, I think with respect to banks, we have to rethink the framework of macroprudential capital buffers. So it's pretty clear, I think, that we will need more macroprudential space, which implies that, as is the case in the UK, that we need a non-zero, so positive level in normal times. I mean, that is certainly a direction in which we should go, and we should discuss this question of the usability of the buffers, which was very important in this pandemic. There was one question on exit. So how long can it take until we can exit from all these measures? So my concern at the moment is mostly that we exit too early, not that we exit too late. But of course, there is a fine balance. I mean, there are of course issues of, I mean, there are issues of moral hazard. There is this issue about zombification. All this has to be taken very seriously. And therefore, I think one has to start now to think about how this exit can take place in a relatively smooth way. So some people call it turning cliffs into ramps. So thinking about how we already now can make sure that that, for example, we do not extend support to non-viable companies, or not we, but the governments, forever. And so these kind of questions, I think, are extremely important. There also, in the question, was also the question, the worry that there could be overheating when the lockdowns are ending. I would think that the moment overheating, at least in the euro area, is not a major concern. I mean, of course, there could be some short-term effect. But if I look at our projection over the somewhat longer period, I think overheating is not the problem that we're actually facing at the moment. Thank you.
Thank you, Isabel. I'm looking at the organizers. I'm afraid of overrunning, and I asked them what would be the capital punishment for doing that. If, however, they say we have to stick to the allocated time, I tried to get a nod on information, but in the meantime, let me say that we have also some questions to say. We overdid it from the public side. A phase of destructive creation would have been painful but advisable. But we cannot live outside the political world that is ours. And I think if central banks would not have acted, I think most people would agree it would have been a much worse situation. And what would have been the outcome is not very clear, but it would certainly have been something that Alex would call very, very ugly. If we do not have any more time, I turn to the organizers if they are willing to extend our time. I don't hear.
Well,
I can
sorry, John.
certainly make a decision. We can certainly make a decision to take 5 more minutes, I guess, if the panelists are okay with it. But they would all have to agree first.
Well, if everyone agrees, I think there are so many unanswered questions that I'm inclined to take the 5 additional minutes and maybe to address those questions which have not been answered, or rather to pursue the intense debate. Of course, the use of buffers is something where we know that it has been affected to some extent with stigma, but that is always the case if the public intervention is being transparent and the banks are concerned that that would affect their credibility. But is any of the panelists feeling particularly an urge to answer a question which he had not had the time to answer?
I would love to have a chance to respond, because my cakeism argument got into some criticism both by Alex and Isabel. I am not questioning whether or not capital standards should be lowered. That was not my point. The point is they are designed to, the basic idea is the higher the capital level, the lower the risk, regardless of the level you set them at. And therefore, for them to be sort of philosophically sound, you expect a monotone relationship between the amount of capital standards and the amount of risk taken by banks. And if the market sees it as opposite, I find there's an element of cakeism involved. And the other point just briefly mentioned by Alex there, of course, I fully agree that nobody really says explicitly we're going to extend Basel III to the non-bank sector. But if you read the FSB holistic document, which I did read, they say, roughly speaking, the following: Basel regulated banks performed well. The non-Basel regulated shadow banks performed poorly. We need to extend the regulatory framework to cover shadow banks. How can one not read that as meaning anything but taking the same regulatory framework to the rest of the sector? If not, why didn't the holistic document say that?
Can I respond to that?
Alex, please. Yes.
Number one, John, if it had said that, I can see why you'd have drawn that conclusion, but it didn't. I've read that document more times than I care to, so I know what it says, and it doesn't say that. And it is, I think, as Richard Berners says in the chat box, that it's about reforming the fault lines that were in the non-bank financial system, many of which share some specific similarities with some of the fault lines that were exposed in the banking system. They're largely about liquidity, they're not really about capital. The bank and apply them to non-banks. The solutions to those will be bespoke to those particular problems. Take, for example, money market funds. Some shadow bank characteristics: they're offering daily liquidity while investing in assets that you can't, particularly in a stress, sell on that one day. They got into trouble, particularly in the States, and required central bank support for the second time in 12 years. Now, once was unlucky, twice, you know the phrase. So actually, that is an area that really does need reform, as the holistic review talks about. But it isn't about applying banking regulations. It'll be about a principle of sort of closer alignment of redemption term and asset liquidity, rather than, for example, capital requirements, as the Basel III requirements are on banks.
I can confirm, as being a former member of the FSB, that the language on this paragraph was very carefully drafted, and there were considerable concerns that it would be read the way Jon read it. And that was certainly not met by a number of participants of the FSB. So from that point of view, I can fully confirm what Alex just said. Alex, do you want to make another point, maybe the last point? Then I turn to Pat. Pat, would you like to make a last point?
No, first, I think Alex came up with the perfect example of why no one's really talking about extending the Basel III regime to non-banks, which would be ill-advised. I would point out mutual funds, of course, it's the second time after the first time there was a reform effort, it fell short. So it sort of underscores that fixing some of these problems, it's easier to state the goal and to accomplish the goal. And even within the non-bank sector, I think what needs to be fixed differs depending on what kind of entity you're talking about. If there's a fix needed for hedge funds, that's going to be quite different than the fix needed for mutual funds. And indeed, I guess my view would be, if you focus solely on hedge funds, you may end up with, it'll end up like a whack-a-mole approach, where you find another class of non-bank financial intermediaries, you regulate them only to find that the activity pops up and another. That's why I at least think so there's some appeal to resurrecting the work the FSB did a number of years ago on margin requirements for fixed income instruments, among other things, where at least in the US, and at least in principle, in the case of our equity margin requirements, they apply to everybody. It doesn't matter what your legal form is or what hole you've managed to occupy that avoids all kinds of other regulations. The margin regulations nonetheless apply. Although that's going to be a big undertaking, because I think the existing US margin requirements, which were in the Securities Exchange Act of 1934 and were focused mainly on equities and designed to avoid a diversion of credit from commerce and agriculture, will not serve us well in the 21st century. So they're going to have to rethink all of that and possibly go back to Congress for additional legislative authority, which is a chilling prospect for anyone that's ever dealt with the US Congress.
Okay, thank you, Pat. I turn now to Isabel. There was also a question that said, how do you feel about part of the reaction in the regulatory field has been to move to financial stability or macroprudential regulators, which are a renationalization in the European context. And in that context, by the heavy support from the central bank, how do we achieve the integrity and the discipline that is needed in the Euroland?
Thank you, Yves. So actually, I wanted to end a bit with more with a question than with an answer. And this is a bit inspired by Alex's comment that he made. actually in his intervention, when he said that when monetary policy is close to the effect of lower bound, financial stability becomes even more important. And so the question I would like to raise, and we're not going to answer it now, I mean, normally when we talk about the role of monetary policy with respect to financial stability, we always have this argument saying that, well, if macroprudential policies are not fully effective, then maybe monetary policy can play a role, which kind of seems to suggest that that monetary policy and macroprudential policy are substitutes. So the intervention by Alex let me think that possibly we should think about whether monetary policy and macroprudential policies could also be complements. I mean, we've had a similar discussion with respect to fiscal policy, so maybe we should think a bit in that direction. So with this, I would like to end.
Well, thank you, Isabel. I think that is food for thought. I would even add that we might give reflection in the same vein, whether there will not be in the future a resurgence of the importance of looking at monetary data. And from that point of view, I think we cannot pursue tonight. I will have to conclude, and I will refrain from doing so because we had many interesting ideas. I want to simply thank not only the speakers for their interventions, for their answers, but also the audience for the questions. And finally, certainly also the organizers. And I will here mention Jon, but also Marcela Valenzuela and Ilke Nur Tser. And the Systemic Risk Center is continuing its research and also its events. And the next one will already take place in a week's time, and you have it on the screen. It has more to do with how national regulation, UK regulation in the post-Brexit would be able to maintain the competitive advantage of the UK in the financial area. But I think you would be well advised also to reflect on the equivalence that other jurisdictions will examine those new legislation from that point of view. And with this, I think I will close the event today with, once again, a big hand for all our panelists and the audience. Thank you very much.
Thank you very much.
Thank you.
Thank you.
Okay.